Ladies and gentlemen, Willie Newman of Home Point Financial.
I brought someone. Is this working?
I think it's working.
All right. I brought someone with me, so it's not just me. This is Mike Cagney. I'm not going to introduce you because we're going to talk about you.
Okay.
So welcome home.
Thank you. It's great to be back.
Excellent. Well, why don't you give everybody your backstory and let us know about your connection to Detroit.
Sure. So I grew up here in the 80s. Spent from age 5 through age 13. Loved it here. Unfortunately, my dad was working in steel and was laid off in 82. And took him a couple years to get another job at 84 in California. So we transplanted to California, to Huntington Beach from here. And I've always had a nostalgia for the area and have had a lot of connections. And obviously, with relationships like the one we have with Home Point, have been coming back pretty regularly.
That's awesome. Well, I think it's kind of interesting that you had to move, your family had to move from the area because of the last session. They were talking about immigration, out-migration of labor, and I think back then there were so many people that had to leave in order to gain employment.
Yeah, it's one of the things that I've always felt is there's a tremendous so first off, Detroit's a beautiful area and it's got a phenomenal population, has great education. And there's a lot of things, a lot of tailwinds that really should propel the area into being more of a technology hub than it has been.
Right. Well, we'll talk more about that. So we were talking backstage. I didn't realize you had done a couple startups before SoFi, but I think the one that people know about is SoFi. So that's when we met originally, which was 2011. So why don't you give us the SoFi story, the vision, and kind of how it evolved.
Yeah, I had, so my first startup I did in 2000, and I was working at a bank at the time, and my wife and I both left our jobs. We had a baby, and I moved my mother-in-law in, so I figured if I did a lot of stressful stuff.
Oh, perfect time to start a business, right?
Add a startup to it. Once I went down that path, I realized I'd probably become unemployable because being an entrepreneur is a very unique thing, and I loved it. I'd started a hedge fund in 2007, and training through the financial crisis, it was challenging. Introduced a lot of stress, and 2010, I was thinking, I really like to start another company, and had a chance to go to Stanford and do a fellowship there for a year, and out of that met my co-founders and launched SoFi. And the premise behind it was relatively straightforward. It was the idea that if you graduate, you have debt, you should be able to refinance it just like you refinance a mortgage.
Right.
And that took off, and now has become a very large company. We actually tried to set up a call center here in Detroit at Ford Field, and got relatively far along in the process. And ultimately, we had call centers at the time in Salt Lake City and Charlotte. Wasn't able to get it over the hump for a couple of reasons, but in hindsight, I wish we had. It would have been a great investment for us.
Right. So talk a little more about the evolution of SoFi. So it sounds like a very simple idea, but it became much more than that.
Yeah, it really is rooted in the fact that the way we think about financial services, we think about traditional banks and the solutions that banks offer. And there's always an adversarial relationship, so it's always kind of you against the bank. Right. And the premise around what we were doing with SoFi was, look, there's a synergy here that you should actually be aligned. So, for example, if you borrow money and you lose your job, the first thing the bank does is try to figure out how to get their money back. And what we did is we said, no, we're going to suspend your loan payments and we're going to work with you to get reemployed. And we actually hired some folks ourselves in that context, but it was just really shifting the paradigm to be aligned with people as opposed to being opposed to them.
Right. So once you did that, we went in that direction. There are so many other services that you could kind of append to that original idea of the refinance of the student loans.
Yeah, it's you're building that relationship, that beachhead through the student loan refinancing process, but then effectively you're in a situation to deliver banking, investment, whatever it might be, insurance,
right,
whatever the relationship needs.
Right, and that was headquartered in San Francisco?
Yes.
I'll ask why, but I think it's probably pretty evident.
Yeah.
But it's good. It's instructive for this group.
Well, and I think it underscores what the opportunity is for Detroit. So, San Francisco at the time had, and still does have a very extensive venture ecosystem. So there's a lot of capital there, there's a lot of talent there. One of the things I used to kind of scratch my head on is the number of University of Michigan computer science graduates that would come out to San Francisco.
Right.
My first engineering team was almost all U of M grads, and not out of intention, but sort of by accident or by default. And I would talk to them and I'd say, look, why wouldn't you want to start a company in Michigan? And the ecosystem wasn't here at the time.
Right.
I think that's changing now.
Right.
I think the gentleman that were speaking right before us talked a lot about developing that ecosystem, and I think there's a tremendous opportunity for that to happen.
Right. Well, I mean, and conversely, in San Francisco, things have gotten so expensive that it's really difficult for people to go out there and make a living, even though the compensation, if you look at it being from this area, you look at the compensation and say, wow, you live out there, and it's not enough sometimes.
Yeah, that's right. And I think one of the challenges the city has is the cost of living has gotten to the point where it's basically unlivable for most people.
Right.
And that's starting to change. San Francisco is one of the few regional areas where the house prices are actually falling right now. But excuse me, it has a ways to go in terms of normalizing.
Right. Which I think conversely is a great advantage for Detroit.
That's right. And I think when people come out here, so I brought some of my colleagues out here for various things. So one of my earliest venture investors, RPM, is based out of Ann Arbor, and they were early investor at SoFi, early investor at Figure as well. And I bring my colleagues out, and they're just amazed because you hear about Detroit, but until you're here, you don't really appreciate what it is, and
right.
just the cool stuff that's going on and the revitalization of the city. Walking, last night we had dinner and we were walking through downtown, and it's just crazy how much has changed over those 30-some years.
Absolutely. Well, I hate to admit it, but being in Ann Arbor is a little bit of a bubble. So coming to Detroit is not something I do frequently, but every time now that I come, it's almost like it's transforming. When you see something that's a little more static, it transforms in front of your eyes almost. I mean, it really is amazing. So SoFi wasn't enough. That wasn't ambitious enough. So you had to go and start Figure. So talk about Figure.
Yeah. So
a little more ambitious, I think.
It's a little more ambitious, a little harder. So what we're doing with Figure, effectively. Figure's a blockchain company, and when people hear blockchain, they think Bitcoin or they think crypto, and blockchain is just an underlying technology that I think ultimately is going to be the foundation for everything we do in financial services. And what we're doing with Figure is we're bringing blockchain into the financial community, so into the mortgage vertical, into the banking vertical, into the marketplace verticals. And one of the things that we've done that's actually been pretty interesting is because blockchain is such a nascent technology. You don't come across someone that's got 20 years of blockchain experience because there hasn't been 20 years of blockchain out there. So what we've been doing is actually working with the universities near our offices and helping to build educational programs. Again, the folks that were on here before were talking about this, but specifically building education programs so people can come out of school and go directly into those engineering roles.
Right.
And what I think people don't understand is, and don't have a great appreciation for sometimes, you don't need a 4-year degree to be an engineer. And you can do that through coding camps, and 6 to 12 months, you can be in a position where you're extremely competent and you're going into a 6-figure job. And I think that's one of the most important catalysts that we can build out, where you've got industry leaning in and helping on the education path so that people have a path where they graduate or they finish their certificate program or whatever it might be, and there's something meaningful for them behind that.
It seems like, the more you talk about it and the more the prior panel talked about it, it's almost like it's becoming a requirement to have, the education system in and of itself needs the partnership with business in order to evolve as rapidly as especially in technology, is evolving.
Yeah, and I think one of the challenges we've had historically is that there was always a perception that you had to go to college, you had to get a 4-year degree, and the reality is you shouldn't feel compelled to do that. You shouldn't have to do that. And in fact, there's lots of very rewarding career paths you can do where you're not going to college for 4 years.
Right.
And I'm saying this for someone that has 3 degrees, so I'm overeducated. I'm such as life.
Do as you say, not as you do.
Exactly. Exactly. But I think providing those Code Academy paths, for example, I think are phenomenal opportunities, and they can take an area and revitalize, inject significant economic into that in very short order.
Yeah, that makes sense. Okay, so let's go back to blockchain though, because you say blockchain will be the foundation of financial services. So tell us why.
So the thing about blockchain and why it's so transformative is it does 2 things that are really powerful. One is it allows you to displace trust with truth. So what I mean by that is you create a native digital asset on the blockchain. I know the composition, the history, the ownership. I don't have to rely on you to tell me what it is. So whether it's a mortgage or it's private company stock or it's a fund, whatever it is that's on the chain, because it's only been on the blockchain and I've known that from the history of that asset, I know exactly what it is. The second is it allows 2 people to transact bilaterally without a settlement party. So if I want to sell you a share of Figure, for example, you'll have stablecoin, which is effectively dollars in your wallet. I'll have Figure stock in my wallet. We face off, and the Figure goes to you, the stablecoin goes to me, and effectively we settle real time instantly with no counterparty risk. When you intersect those 2 things, you create a marketplace where you're agnostic to your counterparty. And this is key because if you think about financial services, all it is intermediated marketplaces.
Right.
So think about how we trade stock. DTC sits in the middle and you're introducing and clearing brokers are on either side of the transaction. How do we pay for things? Visa and MasterCard sit in the middle and your merchant issuing bank issuing processor, merchant bank, merchant acquirers on either side of those transactions. Think about your industry on the loan side. It's not even homogenous to have an actual marketplace, right? And so there's a tremendous amount of application, and what you're talking about are trillions of dollars of existing market capitalization that's going to migrate out of this old regime. The Marqetas, the TSYS, the Visas, the DTCs into the blockchain ecosystem. And this is why I think you have a lot of areas that are really leaning in on blockchain and saying, look, we want to get behind this because we see this as what people call Web 3, which is the next generation of how we think about technology.
So lots of friction today. There's intermediaries that extract, I'll say, rents based on the friction that they solve for, or in some cases create and then solve for, right?
That's right.
And you're saying extract that friction because of the blockchain, and then the where do the economics go then?
Yeah, so
buyer seller or?
Well, so I'll use an illustrative example. So let's take trading stock.
Yep.
So in the context of blockchain, when 2 people transact, they go to what's called a decentralized exchange. So that's just a place where you and I can both attach our wallets and agree to a transaction and not take one another's risk. And again, because I've displaced trust with truth, I know what I'm buying from you or what I'm selling to you.
Yeah, so you're counterparty agnostic.
You're counterparty agnostic.
Right.
And so compare that to the way we trade stocks today. So with stocks, DTC sits in the middle as a registrar. You have your introducing broker and clearing brokers on either side of the transaction. In the context of blockchain, you wouldn't need the registrar because the blockchain is the registry. You don't need the NASDAQ or the NYSE because the blockchain is the decentralized exchange. But you also don't need the introducing broker. So you don't need Schwab or TD or Robinhood or whomever it might be. And so you're talking about the entire ecosystem going away. So where does the value of that ecosystem accrue back to? When you transact on blockchain, you're paying fees, and effectively what you're doing is migrating those fees from those intermediaries to the blockchain. And you pay those fees in the form of the token of that blockchain, and effectively the token of that blockchain is the market cap. It represents the present value of the fees that are going to be paid in. So what we see is, as we're doing things in blockchain, so when people look at Ethereum, for example, or Bitcoin, and it's got a $500 billion market cap, and they say, well, how could that be? If they're right about what they think it could be, it's worth a lot more than that, right? If they're not, it's worth zero. So that's kind of the guess right now is, are the existing protocols going to be the MySpaces of the world, or are they actually the ones that are going to cause a disruption?
Right. So you have lots of entrenched, these entrenched companies and intermediaries, like. They have to be fighting. I mean, are they fighting this? Are they embracing it? Are they trying to figure out how to adapt their model? Like, what is the reaction of a Visa or an ICE, as an example, which affects me as much as anybody.
Yeah, they're not super happy, and as you know, I think you've heard ICE complain about what I'm doing. Yeah, I think I use another example. So DTC, which is the registry of all securities, or most all securities, they've gone out and they've written all these papers and they say blockchain won't work because you have to encumber every transaction. So when we talk about us trading, you had stablecoin in your wallet, and their issue is, well, the way that DTC works is we net 92% of every all the transactions each day. So a fund with $10 million can buy and sell $100 million worth of securities. And so I sat down with them and I said, look, let me explain how this works. You have stablecoin, and stablecoin actually nets itself. And I stood up a blockchain for them that had a couple of traders on it, trading 20,000 transactions a second, instantly settling. And the trader with $10 million in capital, while we were sitting there talking, did $1 billion worth of trades. And
so I guess you kind of refuted that assertion, right?
Well, so I refuted it, and then they said, well, what do you want us to do with this? And I said, well, you can do one of two things. You could say, this is the future, and let's lean in and figure out what role we play in this, because it's not the role we played before, but it's something. It's something for us to do. Or you could pretend I never showed it to you, and they've taken the latter path. So
yeah, well, I'm not surprised. And I think I was just reading an article on Visa, just how the intermediaries, and then there are other countries where the interchange rates are so much lower.
No, that's right. And interchange is not a great thing for anyone. So, the challenge you have in interchange is you have 5 parties that are taking a transaction fee. So when you swipe your credit card, that merchant's paying somewhere between 3 to 4 points in interchange expense for that. And the issue is, it's not, that money isn't staying in the community, it's going to that issuing bank. The largest issuing bank is JP Morgan Chase, and they have an enormous business, they make a lot of money off of this. But it's to the detriment of the community. This is why when you go to the gas station and it's you have a different price between cash and credit, right? And or you have a $5 minimum or a $10 minimum charge for using your credit card. But what's unfortunate is you're taking that away from the merchant, which is taking it out of the community that you're transacting in and that merchant's serving. And so I like to think of blockchain as a phenomenal leveler, right? So blockchain can level the playing field between big banks and small banks. It can level the playing field between enfranchised and disenfranchised consumers. It's a phenomenal leveling force. And one of the things that it can do is create a more democratized payment rail. And so effectively, I should be able to go into your store and transact through blockchain and incur 15 basis points or 20 basis points, not 400 of expense. And this gives the merchant a tremendous amount of flexibility, because I can take that money I was spending and I can figure out how do I want to use that money to either lower your prices or incent you through rewards or through other types of programs. Right. And I think we're going to see this tipping point, and this is something that absolutely terrifies Visa and MasterCard. And sort of the irony is, everyone has a blockchain initiative, but a lot of people have them purely because they don't want blockchain to happen. So we'll see how that plays out. But I'd say the areas you're going to see the biggest disruption in the near term, one is mortgage, and consumers won't see the direct application of this because they don't know what MERS and registry is and so forth. But there's activities in blockchain that are reducing the cost to generate a mortgage by $200 to $500 per loan, and ultimately that'll manifest through the consumer in terms of a lower loan rate. Where you're going to see it more explicitly is payments, and I think over the next 5 years you're going to see a complete disruption of payment networks, where we're moving to something that's cheaper and faster and better for the communities people transact in.
Right. Wow. I don't know about you all, but I feel like going and shorting some stock, huh?
Yeah, I think what's going to be interesting is how the Visas of the world, for example, react. Are they going to lean in and disrupt themselves, or are they going to ultimately be disrupted? And this is a tough thing for a company, and this is why, if you look at the S&P 500 100 years ago, right, or 50 years ago, none of the names that are on there now are names that were on there then, or very few of them. I think there's a couple. And as a company, if your business is working, if you're generating income, if your people are happy, your customers are happy, it's hard to come in one day and say, I'm going to completely disrupt the model. Right. And you and I were talking about this backstage, that with what's happening with the backup in rates and the mortgage market kind of, in a different situation than it was the last couple of years, folks like yourselves are actually using that opportunity to disrupt the model, which is, okay, well, now we get a chance to think about how we would want to build it, because trying to do that 2 years ago was like fixing the car while it's going 90 miles an hour, and whereas now you actually have some runway to do it. And so again, I think how some of these companies react will dictate where they are over the next 20 years. But I'm encouraged that at least some of them are going to lean in and participate.
Right. Interesting. One more thing on the blockchain. One of the things you said was tipping point, and there's a lot of, like you said, there's a lot of entrenched interests. There's a lot of, I'll say, legacy out there. So, near and dear to my heart is mortgage. There's a huge legacy infrastructure of title and recording, MERS and et cetera. Like, what do you do with all that legacy?
It's going to get repurposed into better things. And that's, if you think about, so think about a mortgage process right now. Think about your post-close expense. You got a whole team that literally just tracks documents going from you to Fannie Mae and Freddie Mac. And there's a huge amount of expense. So if you have a digital mortgage, if you have digital registry, you don't have that stack of paper documents, and you know where everything is. In fact, you get the loans to Fannie and Freddie right when you fund them.
Right.
And so what do you do with that team? Well, you repurpose them into other stuff, right? And that's.
But what about all the loans that were done before? They just kind of erode. It just runs off over time, or is there ways to actually convert the old into the new?
There's not. There's not a cost-effective way to do it.
Right.
So and it goes back to kind of what I was talking about originally. For blockchain to work, you need something that's native digital on the blockchain.
Yeah, from day one.
And so a lot of people, over the last couple of years, people talk about, oh, blockchain is great because I'm going to take a Picasso and I'm going to put it on the blockchain, and we're all going to be able to buy 10% of it. So each of us can own 10% of a Picasso. Well, that's totally orthogonal to the benefit of blockchain, because how do you know the Picasso exists? How do you know someone didn't spill coffee on it? How do you know it wasn't sold 100 times as opposed to 10 times?
Right.
And so taking either an analog or a digital asset not on blockchain and trying to bring it into blockchain, there's no value there.
Got it.
And this is, a lot of people talk about tokenization. So there's been companies that have been set up to do tokenization of commercial real estate. And the idea is we buy a commercial building and we all can take a participation interest in it. Well, the title's not digital, it's not on chain, so what do you own? And this is, this is sort of blockchain in some ways was a solution looking for a problem. I think within financial services, it's the reverse. There's clear problems blockchain solves and clear ways to measure that in terms of economics.
Right. Yeah, but in essence, you kind of have to run two systems for a period of time. You have kind of the legacy system and you have the blockchain system, we'll say.
Yeah, I mean, I think in the context of mortgage, your servicing portfolio will run off your legacy assets, your new assets come on chain,
right.
and your origination process and your interaction should be the same. So it should be abstracted. Blockchain is just technology. It's just, you think of it as a database.
Yeah, it's underneath, but reducing friction. So then, like payments as an example, though, that could flip, like.
Yeah, well, one of the key things on payments, because blockchain allows you to move money real time, 24/7, 365. Effectively, think about in the mortgage space, you get paid with ACH, and ACH is an absolute nightmare to deal with because the way ACH works, every day you get a pile of money, and you don't know where the money came from, and some days, 2 days later, the money goes away.
Right.
And so it's a ridiculous payment infrastructure, and you have a ton of people, and most of your servicing costs is dealing with ACH because most of your loans perform, but the performing servicing costs is ACH problems. So think about getting rid of that, right? Having the ability where the customer pays you instantly. And what would you do in return for that? Well, you could incent that customer. You could give them some sort of reward, lower their mortgage rate by a marginal amount, or allow them to skip a payment periodically to the extent that they need to, because you're reducing your expense in a considerable way.
Right.
And that's where all good technology ultimately is deflationary in the sense that what it does is it brings down the cost.
Right.
And first movers that benefit from that are going to keep that margin initially, but ultimately, like in the mortgage space, it'll get competed away.
Exactly. Yeah, I mean, as we've talked about, that's exactly how we think about it. Is that you can think you're getting some additional rent for some period of time, but what you're doing is as you democratize the process, is you're going to lower the costs because there's just not as much friction involved, and it's more of a pure transaction.
That's right.
Yeah. So we should talk about Detroit because we've been kind of nerding out up here. Hopefully, everyone's I understood some of what he said. So Detroit, you started with that. So can Detroit be a fintech hub?
Yeah, absolutely. I think that you've got all the ingredients to make it successful, and including, you have a burgeoning venture scene. So the capital's coming here. You have a lot of people that want to invest into the city and into the residents of the city, and I think that's super important. You have, opportunity for significant education hubs. So obviously you've got U of M, but you've got education hubs within Detroit, and then you have, what I talked about, the whole aspect of setting up coding centers,
right?
Coding boot camps, where companies can lean in and help drive a curriculum that is both applicable to themselves but applicable to the broader technology industry. And you have the ability to create significant jobs off of that and significant income. So I think it absolutely has the elements for it, and I think it's starting to happen a little bit. And there's obviously some very interesting startups in the city right now, and I think you'll see more of that happening. And again, the panel before us, we're talking about how to facilitate entrepreneurship. Being an entrepreneur is very, very hard. But it's one of those things that it creates a network effect. You have some entrepreneurs who have done it, who can mentor others and build that out. I was very fortunate when I was starting up that I had some very good mentorship. My first startup, I did not, I came out of a bank and I ultimately sold that to Broadridge. I didn't have a lot of guidance in terms of what I was doing. And I remember I thought it was I started this in 2000. So this, we had the recession in 2001, 2002. And nobody was leaving the company, and I thought it was because I was a phenomenal boss and everyone loved the company so much. It was because no one could get a job. And I sat down with my co-founders one day and I said, well, how do you think morale is? How are people feeling? I feel like everyone's really happy. And they're like, you're the worst boss ever. and I went through the various stages of grief. First it was denial, like, you don't know what I'm doing for this company. And then, and ultimately I sat in the corner and cried. Realized
we've all had those moments.
Realized I had a lot to and still continue to learn about how to be an effective leader. And I haven't gotten there yet, so I'm trying. Interesting process.
Yeah, I'd say in my career I was fortunate. The first, it wasn't per se a startup, but the gentleman who hired me was starting up a mortgage. He had a mortgage business and he was trying to grow it. And he became a mentor, and I didn't even really understand the concept of a mentor. I just kind of fell into it. But if I hadn't had that, there's just no way I would be where I am today. So I think to your point, there's one, the importance of mentorship I think is huge, and two, having kind of a critical mass of potential mentors available. And I think especially with what the prior group talked about, I think that's what we're starting to build in Detroit.
Yeah, I mean, I think the best thing,
especially if you come back once in a while and help us out.
Yeah, no, and I'm trying. I'm trying to look for opportunities that either I personally or through the Figure or Provenance Complex can invest into the city and into projects that are happening here, because I think there's a tremendous opportunity there. And as I said, it always made me a little bit sad when I'd hire a U of M grad out in San Francisco, and it just felt that there was a tremendous thing here. But, the mentorship thing is important because it creates a self-fulfilling cycle that it's just part of the ecosystem. You need capital, you need mentorship, you need opportunity, you need a workforce, you need a workforce that's educated for what you're trying to do.
Right.
But again, that's where companies can be very proactive and lean in and help drive curriculum. And we've done that. We have a significant call center in Reno, and we've done a lot of work with the University of Nevada, Reno, in terms of building that education curriculum out for both their 2-year and 4-year programs. I think we're going to start leaning and doing the same thing in Charlotte. We have another call center there. There's the opportunity to do that here in Detroit as well.
Yeah, well, I think, and it's interesting, you talk about Nevada, Reno. I don't know where that ranks in the academic kind of spectra, but you don't usually see it in the top 10 schools, right? So the point is, it doesn't really matter as long as there's that kind of that critical mass of, I'll say, education as a base. If you can append to that with what you're doing, then you can start to really build that workforce out.
Yeah, I mean, and my view on it is if you have people that want to work and you give them the opportunity to earn a good living and generate a really good return on whatever investment they make in that education, you're going to be able to attract talent, and you don't need to be. In fact, I don't know that you'd ever want to hire an engineer out of an Ivy League school, so because they probably think too much about stuff. And no offense to engineers, but
My daughter went to Carnegie Mellon, not that it's Ivy League, but it's pretty darn close. So
yes.
You better take that back to her.
Carnegie Mellon is a phenomenal engineering school.
So we have a couple minutes left. Maybe I'll open up to see if there's any questions for Mike. It's hard to see, so.
I'm sorry I talked about blockchain for.
Was that okay? I mean, it's super interesting. Can you hear him?
Sorry,
we
Obviously, Detroit is known as the Motor City, but it's also the center of mortgage. Right? You have two of the biggest mortgage companies in the United States.
Three.
Well, one's in Ann Arbor. But so when you think about blockchain, you think of the likes of Rocket, you think of United Shore. I think this opportunity, as you pointed out, being down market. What does a company like that do to stay ahead of the curve, implement blockchain now? How do they change their workforce to do it?
Yeah, so it's a really important question, and you know, I think if you look at Home Point and Rocket and UWM, you know, you've got a significant nexus of mortgage here, and that's what I think is one of the interesting things to help drive fintech investment and being a fintech hub is you know, there's a lot of technology that should be catering directly into those businesses, and having a local presence and being able to you know, go and have conversations like this on a regular basis really help facilitate that. So I think one thing is the hub should attract technology. I think the other is, you know, as those companies are looking at the technology, to Willie's point, like, what do you do with the people? Well, you know, you redeploy them. And you know, when in 2021, you know, no mortgage company had enough staff, and so, you know, having that efficiency is super important. But also introducing an efficiency. You know, the crazy thing about mortgage is it costs almost $9,000 to generate a mortgage right now, and almost all of that is human cost. So there's very little technology component to it. It's almost all physical work. If you could flip that paradigm, it puts the mortgage businesses in a position where they don't go through these boom-bust cycles, because, you know, when things are great, they're hiring tons of people because it's manually intensive, and when things are not great, they're laying off tons of people because it's manually intensive. And if you could make that more technology-centric, you could drive greater efficiency. This is part of why there is no mortgage company that owns over 10% of the market. It's a massively fragmented market. I think technology like blockchain would allow for some economy of scale and consolidation, because if it's a human capital intense industry, there is no economy of scale.
Right.
If it's technology, there's massive economies of scale. And so I think what blockchain will ultimately do, it will underpin the underlying mortgage industry, it will lead to consolidation in the mortgage industry, but it'll eliminate some of the cyclicality that we've seen in the mortgage industry. And in terms of the education and training and so forth, it's just, you know, on the front end, in terms of the production process, it's creating a different mindset. You know, the way that people traditionally generate mortgages is a human capital intense process. You get you know, you submit your information, they do an initial underwriting, someone looks at a 1003 and types in a bunch of data. It's kind of goofy. So there's a better way to do this. So it's just training your staff into a new way to think about it. And that's what, you know, I think Willie was talking about earlier, and I think is the right thing to be thinking about now. You know, mortgage industry is slowed with rates backing up. It's a phenomenal time if you run a mortgage company to lean in and think about, okay, well, how do I want to reinvent myself to come out of this in the next cycle? Because there'll be another cycle. And you know, so we'll see how many companies actually do that. I've been pleasantly surprised at how many mortgage CEOs have been very progressive into this cycle, thinking, okay, I want to bolster this business out so that when we come out on the other side, I look different than I did before.
Well, I think the cyclicality. I mean, this is I've been pretty public with this. To me, this is the most challenging cycle since the financial crisis for mortgage. And in some ways, it's actually more challenging because of the shock that took place from an interest rate standpoint. But I'd say for us, you know, there are kind of two things. One is we don't have a large technology group, unlike a couple of our brethren here in the area. And so we depend on partnerships in order to really leverage technology, which is why our relationship is so good. I'd say the second thing is I would prefer to have every associate at Home Point focused on the experience instead of all the people that are focused on, like you said, kind of manufacturing, remanufacturing, patching the widget that comes in. And even with all the money that's been applied to technology in the mortgage business, you still have lots of people that are doing that instead of focused on the experience. We do business with mortgage brokers, so focus on experience, focus on the relationship with the broker. That's where I would move everybody at Home Point to that part of the process if I could automate the rest of it.
Yeah, but I think in the context of Detroit and investment in the city, you've got 3 of the largest mortgage companies in the country. Mortgage is the largest private capital market in the world. If I was a fintech starting out, I'd be looking at how could I go and get into that ecosystem,
right.
and how could I build a business around that nexus. And as I said, with the capital coming in and with the ability to pull human capital in, I think there's a tremendous opportunity. And mortgage could be a real catalyst to make Detroit more of a fintech hub.
So you put it back on me now, because I was putting it on you, now you're putting it on me, so, all right. I'm in.
You should buy more technology from me.
I fell into that one.
Really about purchasing stock. How will blockchain affect financial advisors or wealth managers in the retail space?
Yeah, so it's...
How will blockchain affect financial advisors and wealth managers in the retail space?
So we did a transaction last year in the fourth quarter. So one of the, Figure's a holding company. We have a bunch of subsidiaries. One of our subsidiaries is called Figure Equity Solutions. And what that does is companies keep their cap table on the blockchain. So who owns what stock, how much stock they own. And what we did in the fourth quarter of last year is we set up a limit order book, meaning basically a way to put bids and offers onto a marketplace. Where our employees, our investors, anyone who owned Figure stock was able to go and attach their wallet into that marketplace. And institutional investors came in and they bid on that stock. And for 24 hours a day, 7 days, we ran a marketplace where our stock settled instantly. So where it takes 2 days to settle on the NASDAQ or the NYSE, it would settle instantly on this marketplace. What was more relevant about that transaction is traditionally with private companies, when private companies sell stock, it's only the most senior executives that get to do it. And what this did, and this goes back to my whole point about why blockchain is a leveling force, anybody who owned any stock could put it up on offer, and it was the exact same price that anyone else would get. So there wasn't any differentiation. The CEO didn't get a different price than someone working on the line. And it gave liquidity in a significant way to folks where, as we have more and more private company development, and these companies stay private longer, liquidity is becoming a very, very important thing to be able to access. And so, what that did is it introduced a lot of liquidity to a lot of folks that would have traditionally had to wait 5, 6, 7 years out. So the next question became, well, what do I do with the liquidity, right? So I just sold, I had a windfall of $500,000 or $1 million or whatever that number is. What am I going to do with it? That's where I think there's a tremendous opportunity for the financial advisory community to lean in, because you're going to see blockchain unlock liquidity faster. You're going to bring wealth into people sooner, and no one's serving those people. So like my engineers, no one's calling on them for wealth management services. You can't.
You got somebody now.
I get called every day, and I'm like, well, I run a hedge fund. I don't need any wealth management. But my engineers, nobody's calling them, and they're pulling out $500,000, $1 million on these secondary transactions, and they're going out and buying 4 trucks, and that's cool. But there's other stuff they should be doing with the money too.
Right.
So I think what it's going to do is it's going to open up an opportunity for advisors to lean into a relative greenfield market where it hasn't been there historically, but it'll be there going forward.
Awesome. Well, I think we're getting the hook, or the red light. So thanks, everybody. Really appreciate it. Thank you, Mike.
Thank you.